Hey, welcome everybody to another eye opener. This is Market Wealth Daily's quick little video chats that we do with top traders. We have got Keith Harwood here with us today. Keith, thanks for jumping in. Uh,
Absolutely.
really looking for some help, some guidance here.
Right.
Got some wild stuff happening in the market and a lot of strings being pulled right now. And which one is going to be the one that makes the money rain down on us? That's what we're looking for. So I'm turning to you, and I want to see what's got your attention now because I feel, and in all fairness, I've felt this way multiple times throughout this year that we're at a turning point, and this market just keeps humbling me and humbling me. So I'm going to hand it off to you and let you tell us what you you think is happening here.
Absolutely. Yeah. Last week was a heavy news week, and we kind of knew that coming in that it could be an interesting week. We had the FOMC announcement on Wednesday that the market didn't necessarily take too well. It wasn't bad, but it wasn't great. Overall, the 10-year yield, as you can see, as we went into the end of the week, started to fall down. It had been kind of pinned towards 4.4% and started dropping down towards 4.2. So some concerns about the economy between FOMC and eventually non-farm payrolls, and then upscaled tariffs again. So we've got a lot of potential bearish inputs right now in the market. FOMC didn't move. Seems really likely that in September they're going to move, but that's now still a month and a half, almost 2 months away. Um, so we've got time before we can start to lower interest rates, and that may create a little bit of a problem for the market, not having a meeting in August. Non-farm payrolls weak, and then revising numbers previous to worse shows that the economy's not necessarily in the best spot. It creates a little bit of a concern. I mean, naturally, and that's what we saw on Friday in particular for like the S&P 500. We had a risk-off reaction. Positive earnings out of Microsoft and Meta tried to get us into a breakout on Thursday morning. But then once we started getting other news, it just pulled us back down. And we started testing some big support levels. Now, Monday was great. Monday, great day. Market bounced back. It's going to be hard, it seems like, though, for the market to push back to a new all-time high without a change in the fundamentals. And that change that can really occur right now is tariffs, trade. That, as we've proven, takes time. At the same time, this market is trained, and we've talked about this before, where the market keeps getting trained that every dip is a buying opportunity. We don't have to sell, because even if you were selling for a long-term investor thinking that this tariff stuff was going to create problems, you might have been getting out of the S&P 500, 25% ago, and missed out on this whole rally. So there's this, I think, desire for most of these long-term investors to say, I'm not going to have a whipsaw reaction, get out and reevaluate later. If you're long-term, in the long run, this stuff works out. And it may be months, it may be weeks, it may be years from now. But if you're looking for an investment profile that's years down the line, I think there's still a lot of confidence there. It's just what happens along the way. How much noise do I want to take? If I don't need that capital and I want to be invested, I want to ignore that noise and say these are buying opportunities, not opportunities to reduce my risk and reposition necessarily, unless it's a rotation.
Mhm.
So overall market, I think, is being trained to say buy these dips. That's, I guess, the long and short of it. And as a result, we see some of these short-term trading opportunities being a little bit more questionable. And, we'll talk about Schwab because it was an idea last week and it looked like an interesting setup. We had some
Mhm.
really positive earnings. And then on Friday, Schwab, along with anything financial related, did take a hit because the economy was looking a little bit questionable. And when the economy looks weak, the market hurts financial companies. So when
Yeah.
will financial companies really lead the market? Maybe it'll happen before the next non-farm payrolls update. Maybe it'll happen before the next Fed announcement. But maybe people just kind of take a chill pill on the financials, and decide, you know what, I'm going to focus on stuff that's really working.
Yeah.
And that's kind of been my thought process here as I go through digesting some of this news is, okay, well, what's really working? And, you know, the answer is staring right in front of me. And it's something that we utilize for all of our systems, and it's AI. I look at
Yeah.
the recent earnings. We had Meta earnings on Wednesday afternoon, and they're moving very heavy AI focused. and jumped and had one of the best earnings results and stock reactions in years. We had Microsoft that had spectacular earnings, a really bullish response, and then pulled back because of market behavior on Friday, maybe leading to an opportunity. And then, of course, if you're thinking AI, got to go to Palantir. And Palantir had earnings yesterday after the close. Before earnings went to a new all-time high, and then earnings themselves another $10 this morning. So all this
Yeah.
AI stuff is really kicking and really working well. So,
Yeah.
I played around a lot with a bunch of different ideas, and then decided that, you know what, I need to just focus on what's working and say, if I'm going to get into this market, I don't necessarily want to play off of SPY, because when I go to my forecast toolbox, I had XLF or up just a few minutes ago, I look at SPY and I say, okay, well, there's a headwind here. There's a
Yeah.
desire to get out because of concerns over the economy. But when I look at stocks like, um, and we'll just touch on Schwab real quick. When I look at Schwab, potentially a little headwind here because of the financials. So, for me, that means that's go back to my old philosophy of maybe this trade doesn't line up right now. I wouldn't enter it today. So, I'm looking for an exit here in the near term, and maybe we get a nice run towards 97.5 or 98 to take the position back off for a small loss relative to where we were last week. And that's a decent return given the current market environment where we had, a couple of percent pullback on Friday, especially at the lows.
Yeah.
But when I
What-
go to some of these AI names, one of my big focuses now is saying, okay, where can I get that leverage? There are not a lot of stocks that are showing bullish momentum, but Microsoft is one of them. Meta is very similar, but Microsoft is a nice, consistent looking bull market that is recovering as people start to say, well, hold on. I think going through that same evaluation and saying, well, Microsoft, there's nothing wrong here. There's a reason it was $555 on Thursday morning. And right now it's 535. So it's on sale.
Yeah.
And should it be on sale? Well, it doesn't look like it necessarily should be on sale. If AI can still perform well in spite of everything else, then why is this on sale? And if I go out even just to say next week, if we're looking for a potential for a new all-time high in the next week, that's where I can see some leverage. I can see prices at 560, maybe even as high as 570, with some really interesting recovery from this most recent trade move. And so, when I look at Microsoft, this is more of my leverage trade. It's not necessarily a home run, slam dunk guaranteed thing because we do have a headwind to the broad market. But I can look for something, short term or medium term. And, playing around with some thoughts here, I went out to September and looked for just what could I do if I have a month and a half and let this play out with a little bit more time. If this does come through, I'd like to maybe hold this a little longer than going for like an August expiration in 2 weeks. And the 555s, normally not always my go-to here, but if I'm looking for a new breakout to a new all-time high, I want to be in something like the 555s or even the 560 calls expiring in a month and a half. And so when I look at the 555s or 550s, let's go with the 555s. That is at the strike of the high on Thursday morning. These are about $6.5 to $7, probably closer to $7 with this pre-market rally, thanks to Palantir earnings. And if we do get that appreciation in the stock price and we just go back to the previous highs, these could easily be 12, 13, $14 options.
Mhm.
So, to make the money, yeah, I have to see this happen. I have to see Microsoft getting that money flow. This is where I can get a big return on capital, but I have to also understand that with the market conditions, and there's this somewhat concern that we may not go to a new all-time high, that Microsoft may have a little bit of a ceiling for it at 555. Still a profitable trade on 555. That's the big key for me. And when I look at like Meta, it's already back there. So Meta is already back to those previous highs, re-achieving some of their move from their earnings. And Microsoft may be a good spot to try to play for that catch up of 3, 4, 5% in a environment where the implied volatility has gotten hit, so the options are cheaper, and it should still have that bullish momentum. So I like Microsoft, but that's not for everybody because this is the idea to me where the market has to continue to just buy this dip and say, if we go back into a March of this year kind of scenario where we just drift lower. It creates a big headwind for Microsoft, even if they are fundamentally on their own a very positive potential trade. So along with that, I wanted to highlight one other potential idea, and that is actually just to go through another big tech name that had good earnings, but got hit off of Friday's news. The tariffs, the non-farm payrolls, and everything else. And it's found support post earnings. 200 looks like a pretty strong level here for Apple. It is struggling to get below there. Apple, generally speaking, struggles to really go into liquidation mode. And yes, it can do it if we repeat April, just like everything else. But if we don't go into liquidation mode, which seems less and less likely when we get moves like yesterday, I go back to my forecast toolbox and say, okay, well, at the very least here, instead of having that bull trend, this is one of those scenarios where the downside looks pretty limited. And our model is showing potential low move down towards 199, maybe down to 198.5. And that's where I start looking for a higher probability of success, potentially lower return on capital trade, which is a put credit spread. And if I go short time frame, as long as the market doesn't go into liquidation mode in the next week and a half, I can generate a decent return on my capital. And so where that really comes in is if I say to next week, a put credit spread selling the 197.5 put, which should not come into the money, even on our low case for the market being a little bit weak and Apple finding support here around the 200 to 199 level. My pricing is not currently showing, but the 197.5, 195 put credit spread, sorry, we're too close to the open, so the pricing stopped on us. This put credit spread is around 60 cents. So if I collect 60 cents for a $2.50 wide vertical, the max loss is $1.90, the difference of the spreads minus the initial premium collected. It's not a big leverage trade. I'm risking more than my potential reward, but I have a high probability of success. So if I am technically risking $1.90 to make 60 cents, I need to make money, gosh, around 70% of the time. So this has to work 70% of the time for me to generate a long-term expected value of positive returns. All right. Do I feel like that's a pretty good setup? I do. The 197.5, 195 put credit spread looks pretty good. It was a bullish earnings announcement that got pulled back by market behavior. And I don't have to have Apple go up. I just have to have it not go down.
Right.
And on top of that,
Yeah.
I
In
can
fact,
modify my risk parameters to say, well, if we breach 198, now I'm concerned and I could sell or buy back my put credit spread for maybe $1. And now I've changed my risk reward even further to a point where if the market goes into liquidation mode, I am out before this hits the max loss. I still factor in my sizing based upon the max loss, but my expected loss may be closer to 40 or 50 cents instead of $1.90. And now all of a sudden I have a positive expected return higher than my expected risk, unless the worst should happen. So put credit spreads can be a little bit difficult, and I mean I know we haven't talked about them too much, and not everybody's familiar with them. And I am always happy to talk through how put credit spreads work a bit more. But that's a spot where if somebody has a question about a put credit spread, I would recommend maybe throwing me an email and we can talk about it a little bit more offline. But generally, I can create a scenario here in Apple where whether the market goes flatline, a little bit weak, or bullish, I can still generate a high expected value trade by selling a 197.5, 195 put credit spread for 60 cents that should more than 70% of the time, based upon all my analysis and historical behavior, generate that profit. And part of the key for that is, and right now actually that put credit spread, yeah, it's about 55 cents as we start to see the market open here. When I look at this one, my system's a little slow here right at the open. The implied volatility of Apple is elevated, which I use this live vol tool here to check that out. We've normally seen or recently seen movement of around a 14% realized vol, and it's pricing in 27%. So what does that mean? The market's pricing in twice the move that we've seen even with earnings. And when the market's pricing in big movement that's not happening, that's where I look for credit spreads instead of debit spreads. We're not looking at an inflection point of breaking out to new all-time highs. We're not at an inflection point of breaking to new lows. We're in the middle of a chop range. And generating income with put credit spreads is a really good strategy to, I think, help a lot of people. And a lot of people use that exclusively instead of these long outright calls. So I don't want to make it sound like the forecast toolbox is only good for those bull cases like Microsoft or some of the other ones that we've seen in the past, like JP Morgan when financials were getting bought. It can be
Right.
utilized for high probability of just not moving. Getting that confirmation from the AI toolbox helps me pick my strikes to make sure that I'm not too aggressive. And if I sold a 200 put, which would have been my normal thought process, I may experience a loss that doesn't necessarily line up with everything else going on in the market. And so now I just change my structure a bit to increase my odds of success and the expected value of the trade. So there's a lot to that kind of thought process, but the general thought here for me is Apple, a stock that shouldn't go down too aggressively, so I can look for a put credit spread to generate income. If the market is going to be more on the bull side here and recover from this move on Friday, then I look for Microsoft for that outsized performance to the upside. And anything in between, I just want to try to disregard those financials and things that just don't necessarily look as clear to me at this current time frame. So focus on the stuff that's working, focus on the stuff that is higher probability of success, and trade accordingly. And actually, with a little dip here in the morning, that put credit spread should be coming up, but that's not a bad thing. That just means I can generate a little bit more income selling that put credit spread. And you can see right now it's up to 65 cents. That's a great entry point for me. And I think it looks like a really interesting trade.
Oh man, that is a lot to
A lot
consume.
in a
A
short
lot.
amount of time, I know.
Yeah, right, right. We are definitely going to have to put a marker out there to just do one of these just on the nuts and bolts of these credit spreads and
Yeah,
kind of talk through it. And because I mean it's a useful tool to have. And
yeah,
as you continue to trade more, for those of you that are out there and have got eyes glossed over and you're kind of like, what? This is out of my range. As you trade more, it becomes a lot easier to understand and utilize these. There are tools out there that make it a lot easier. So we got to jump in and we'll have to give everybody kind of an on-ramp to credit spreads and let them
yeah,
know how it works. The other thing I was going to say too is this dip that we saw on Friday. Has done some really interesting things. First, I would highlight where the money's really moving, and it's not equally distributed across the sectors. We're seeing these big moves in tech, and when those big moves, that huge momentum, also gets dragged down by the broader market. There's big opportunities there. That kind of
yeah.
goes into your Microsoft theory. It's like there's opportunity there. We can take a look at that. So uh, I don't, and we were overbought. I mean, technically, if you look at the across the market, it was just definitely frothy. Giving it a little bit of space will maybe help continue the rally. It'll save the rally. You gotta
Exactly.
you gotta have those pullbacks, and then you get people buying in. They're buying, like you said, buying the dip. So it keeps that rally going, and you know, gives you. I wouldn't say makes it easier, but it's typically a more comfortable climate for people to be trading in than when markets are dropping. So takes a little bit of stress out of everybody's life on the basic level.
Yeah.
But yeah, so good to watch how this is going to play out now and see what we get already. Like you said, the market's just open while we're in this chat, and uh, kind of watching it, try to find out what it wants to be when it grows up today.
No, exactly. And I think you keyed in on something important here. When we've got the market with like this 70 plus RSI, that's usually not a long-term um, successful time to necessarily overload buying the market. We've got to be very stock selective, look for those opportunities. So getting these dips actually highlights the new opportunities, and then I can look to see what the market is reallocating to once the dip happens. Because the natural reaction is just to kind of sell everything and then reevaluate later. So when we see how the market reevaluates when a stock like Microsoft gets hit, if people immediately run back to Microsoft to start buying back in, that tells me that great, the price at 555 may have been the right price, but nobody was ready to buy because just they were holding off until they figured out where the dust settled. And then as that dust settles and they start allocating capital, then we see those clear signs of where the investment money flow is. Um,
Yeah.
and so it's a little bit of a give and take, deciding whether I want to be maybe a little early in Microsoft while I'm expecting some more money flow there, or saying, I can get a good return for the next week by selling in Microsoft, an Apple put credit spread while the dust is settling, generate some returns, and then when I have a bit more clarity on what is truly going to be continuing to be bullish, go back to those bullish cases. So,
Right.
both strategies I think can really work. Both should have a positive expected value. Doesn't mean that they win every week, but they are both, I think, potential ways to put some capital into the market, maybe not taking the full risk of being completely long everything right now because we do have some question marks out there, and figuring
Mhm.
out which stocks and sectors I'm comfortable with. And I'm not comfortable in United Healthcare. I'm not comfortable necessarily in financials, but I feel much more comfortable in stocks that had a bullish earnings input, which Microsoft and Apple both did. And then saying, okay, well, if those just got hit because of broad market behavior, that shouldn't necessarily continue. It was more just reducing risk before other people say that's an opportunity I can buy it when it's cheaper.
No question about it. And then being able to look at these different tools to use to really kind of find the optimal position to take in light of all this that we just went through. The context is invaluable. The tool education on the different tools is invaluable. Just again, it's another great opportunity to have you here, Keith, and have you sharing all this stuff with us. And
Yeah.
a great point that you made earlier too about the forecast toolbox being more utilitarian than just a directional trade machine.
Yeah.
It offers a lot of information that when you apply it. So hopefully somebody will take you up on some of this stuff and reach out to you and shoot you an email. Uh, we're gonna obviously we'll put a link to that toolbox in the email as well, and hopefully people will take a look at it. I know there's a trial offer. Go in there and poke around, take it for a test drive. I think it's definitely something that you want to have on your desktop while you're looking at these charts, and it's just a great kind of gauge of what to expect out of that position.
Exactly. And it's one of those things that it can be a very confirmatory tool or a tool that tells me may want to wait. So if my desire right now is to buy into financials, or I was talking to a guy yesterday who said, oh, maybe I want to buy into some silver. Silver's up a little bit today, but the forecast toolbox doesn't necessarily show a lot of bullishness for silver in the short term. So it can help for timing on more investment philosophies, knowing that there may be some weakness here in silver in the near term. Maybe I don't want to be loading the boat today after the dip. Maybe I want to
Hmm.
be reevaluating and waiting a little bit longer until the tariff stuff comes out. Um, it just helps me to know what should I be focusing on when I'm looking in the short term and when I'm looking at long-term investments, when the market investment flow just isn't there. And silver right now is kind of like, pull back and doesn't look like anybody's really aggressively buying. And, if I'm looking long term, maybe it's still a good buy, but I might be able to get a better entry in silver, for example. Or, I mentioned UNH, just knowing that this is something that I'm just going to stay away from because this has been a bad stock. They had weak earnings, and there's no money going into it right now. And with the market giving a headwind, I don't have any interest in necessarily saying I'm going to buy UNH now because it's cheaper than it used to be. I used to be a
Hmm.
market maker in this stock, and it was, a $25, $26 stock 20 years ago. And, you look in hindsight and say, God, that was a great buying opportunity back then. Looking back at that sort of stuff, though, also kind of puts stuff in perspective of how big this rally has been over the last 15 to 20 years in United Healthcare. And if they've got real problems, I don't know how low it can go, but I certainly don't need to be getting in front of a train here and saying I'm gonna be the one to stop it. I don't stop a train. I just try to ride the
Don't
train when it's going the right way.
Yeah, don't catch a falling knife, right? That's the
Exactly.
old adage. Definitely. Yeah, good insight on all of this. I mean, definitely in a unique time with the market, a lot of things that are making us rethink some of the assumptions of tools that we've had out there that we've been kind of relying on. But I think we're getting smarter, and to be able to have the capability like the forecast toolbox offers to process a massive amount of information, just
Mhm.
useful on so many levels. So definitely
Yeah,
going to put a link to that in the message. Keith, thank you so much for taking the time today. Really
absolutely.
appreciate having you here. This is always great. Everybody, please keep your eyes open for the next one. Join us live. Telling you, we talk about this stuff. I've been saying this, trying to drive this home. I know everybody's busy, so I always hate to put pressure on everyone, but we'd love to have you in the room with us because by the time we get this edited and sent out, a lot can change. A lot of the stuff we've done still works great, but man, you could miss out on some of the sweet spots if you're not in here
Oh,
with us. So
absolutely.
yeah, keep an eye on the
Start
schedule
smooth.
and yeah,
Knowing
yeah.
24 hours before anybody else can also be a nice tool, because then before, by the end of the day today, Apple might be trading 207, and say, okay, well, now the put credit spread doesn't have enough premium for me to get into it. But we'll see how it goes,
There's
right?
definitely that. Yeah,
Yeah,
absolutely. So definitely if there's any way you can make it, we want to have you here. All right, Keith, I've taken up too much time. Thank you so much. You have a great day, and everybody else have a great day as well. And we'll see you guys all soon.
absolutely. Thanks again, everybody.